All right. Well, welcome everybody to our Easter Passover post April Fool's session we've dubbed Turnout Tuesday. And we're here to talk about tax law, trauma, and triage. I've gone away from calling it tectonic. You'll see why. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing. I'm joined here by my dear friend, Mr. Ken Kavula of the Central or Mid-Michigan area. Say hello, Ken.
Hi, everybody. Glad to be here this evening.
And hopefully everybody got out there and found their Easter eggs, and we had a great time with the grandsons, and it was a good holiday weekend. And we have other family reasons to be joyful also in our particular family. But for tonight, we're going to concentrate on how Capitol Hill has been messing with us a little bit in our role as would-be investment analysts / stewards of our portfolios. We're going to talk about the Jobs and Tax Law Act. And we're going to feature a couple of case studies, talk a little bit about Apple, principally because of the magnitude of what we're talking about there. Some issues with Johnson & Johnson, again, just using this as kind of case studies, and then look at a reminder from Warren Buffett and Berkshire Hathaway about asset-based companies and how some of the stuff that's going on, the shuffling, is affecting some of those type of companies. So with that, let's go ahead and jump right into it. Our two email addresses are on there, kkavula1@comcast.net, markr@manifestinvesting.com. If you have follow-up questions, we do encourage anybody in the audience who is wrestling with any of these and has any aspects about this to share, you're most welcome. Here's our legal paperwork to get out of the way. We're going to talk about those companies, so we want to make it clear that no investment recommendation is intended. This session, like all the sessions that we do, is about the power of demonstration. It's about illustrating and walking through the method and processes used by a nation of investment club-based investors. So that's basically where we're coming from on all of this. So again, do your own homework and conduct your own review of any companies that you might be interested in before making a decision. We will try to remember. Go ahead, Ken.
Let me add at the end of this, Mark, that my wife currently sends out reminders to over 800 people throughout the country, and we'd love to help you remember our Turnout Tuesday and our roundtable programs. If you're not getting a reminder from us about those programs, if you'll send an email to nkavula1, that's Natalie, not myself, it's nkavula1@comcast.net. She'll add you to the reminder list, and she'll be glad to add any of your friends or acquaintances that might want to attend as well. All we need is their name and their email address, and we'll be glad to add them to our list of people we remind.
Okay, let's go ahead and press on then. And again, this is something that we have been kicking around for a while. We've kind of covered this from 35,000 feet. We want to come down to at least 34,000 feet here tonight and talk about the changes in the tax law and the turbulence and some of the challenges that it will cause for stock analysis.
Mark, I'm gonna stop for a second. We're getting a lot of messages that we're getting no audio. So I'm gonna try to check to see if our audio is on.
Okay.
It appears that the audio is working.
I'm looking at mine. I'm showing fine on this end as far as microphone levels. How many messages, Ken, are
I'm 8 or 10 here, yes.
Wow, that is unusual.
If you're getting audio, can you... Oh, we're getting a lot now. We're getting the webinar will begin shortly. So, boy, oh boy, let's see what we can do.
I'm showing attendees still on hold, Ken.
The broadcast is now starting. All attendees are in listen-only mode.
All right. Well,
hi, folks. That should have solved our audio problem, and that was just user error by yours truly here. So let's back this up and really quickly do the disclaimer again, Mark, and the introduction, and make it so that everybody can hear what we're doing. Okay?
Okay, we're good. Looks like everything's okay now. Sorry about that, Ken. I should have caught that too on what's going on. All right. Well, again, welcome everybody. We again with a nod to Easter, Passover, and the holiday weekend just behind us, and hopefully many days of spring ahead. We are here to talk about how the new tax laws have shuffled the deck a little bit and could become a little bit more challenging for a nation of investors who follow the investment club based methods of analysis and taking care of their stocks and being stewards of their portfolios. My name is Mark Robertson. I am founder and managing partner of Manifest Investing, and I'm joined here by my good friend Ken Kavula, who hails from the mid Michigan area, just north of me, about 40 minutes. Say hello, Ken.
Hi, folks. Glad to be with you this evening, and we apologize for starting late. You have to press a series of buttons, and yours truly forgot to press one of them. So let me take you to the disclaimer real quickly. This is a demonstration. It's for educational purposes only, and we will be talking about real stocks in real time, but we're not making any recommendations to buy, sell, or hold. We urge you to do your own analysis and draw your own conclusions. For those of you that already are on our reminder list, you know that we get a reminder from generated by my wife monthly. If you are not getting a reminder, or if you have friends or acquaintances that you'd like to add to our list, please send an email to nkavula1@comcast.net. The email's on the bottom of this disclaimer slide right here. She'll add you to the list, and then once a month you'll get reminded to register for either Turnout Tuesday and or the Mid-Michigan Roundtable. So we're glad to have all of you. We send out over 800 reminders already to folks outside of our chapter, and we'd be glad to send out a reminder to you, your friends, your acquaintances, or anybody else you think might be interested in this type of program. Let's get going now since we're a little bit behind time, and I'll send it back to Mark.
Okay, not a problem. Again, so we're coming at this. We've talked about the tax law, shuffling of the deck, and how Capitol Hill has given us some perhaps potentially challenging moments in our stock analyses, our stock studies. So we want to come down a few feet and take a little closer look at it. We'll probably be doing versions of this for some time to come. We do want to remind that neither Ken or myself, neither one of us are accountants per se, and we certainly don't play one on TV either. So keep that in mind. But what we're seeing is a fairly significant, perhaps not tectonic, as in continental shift when it comes to this, but it is a situation that we want everybody to be aware of. As you're going to see, we consider it to be a work in progress, and we're going to go through case studies on J&J, Apple, and Berkshire Hathaway, and we'll try to leave a little bit of room for Q&A as always, and still try to keep this under an hour or so.
Mark, I'm going to jump in here. We have a hand up, and we do allow you to ask questions. That hand icon is a little bit confusing to some folks. So I'm going to unmute the hand that's up. It's Bruce. And Bruce, you're unmuted. Do you have something to ask?
No, I don't. Sorry about that.
Okay, I'll take the hand down and mute you back up again.
Well, we know the microphone works.
Yep, the mic works just fine.
Press on?
Okay, I think we're all set. Let's press on then, Mark.
All right. So again, we're kind of circling back to a couple of questions we had at our session last month. We kind of touched on them a little bit, but again, a lot of words there. But what it comes down to is we're seeing some erratic earnings per share and year-end results, and things are changing and what's going on. So again, Valerie is asking us for some discussion on what to do as we evaluate companies going forward. So we'll try to tackle that. Bill Thompson also gave us some specifics where we saw Johnson & Johnson have a fairly significant disruption. So we'll look at that one specifically, and then he went on to mention other companies like Southwest Airlines. And as we go through here tonight, again, the point is that some industries are affected a little bit more differently. Some are more severe than others. A lot has to do with the cash on hand, the cash offshore, and then also things like accounting conventions on deferred tax liabilities and that kind of stuff. So it's a mixed bag, and just keep in mind that every situation is going to require you to take a little bit different look, a little bit more careful understanding of some of the stuff that's going on. Anything you'd like to add to that, Ken?
No, but we do have a couple of different types of adjustments that we're going to have to kind of keep an eye on. So it's not going to be just one flavor when you're looking at that long list of adjustments that some companies have put together. So keep that in mind, and we'll try to explain some of the vocabulary. If we end up with a subject matter expert out there in our audience, we'd love to speak to you and maybe run a separate program where we can just do Q&A to somebody that's really familiar with corporate accounting, or especially the tax matters within the corporate accounting. But at the present time, we're not going to have an expert. You're going to be stuck with Mark and I. And again, for the second time in a very short amount of minutes, we're making the point that neither he nor I are accountants, and we're just giving you our best regular investor guy kind of talk that can kind of help you get started on at least grappling with some of these issues.
Fair enough. So let's talk about the specific disruption, and it has to do with some of the changes that were made toward almost Christmas, just short of Christmas Day, late in December. And the federal corporate tax rate was adjusted from 35 down to 21. So, I mean, that alone is going to obviously cause some changes in the back end of any stock selection guide. So, just something to be aware of. That has changed. The slide that you're looking at is actually from Heritage and just kind of gives a quick rundown of some of the stuff going on. They also made changes to the way that some of the aspects of traditional accounting are expensed. And those rules will change again, how the bottom line is formed for many companies. Probably not a really major item on some of this, but again, there is a bit of a disruption as to how some of the expenses are amortized over 5 years, and the rules will be changing. Third, and probably most third and fourth, basically how the repatriation and the taxes that are applied on a global basis are done. And as part of the deal that was struck, the repatriation allows companies to bring back money from overseas, 15.5% on liquid assets, 8% on physical assets. And many companies have already begun to position themselves to take advantage of that. And it's causing some moments. The Heritage research that we looked at for this is actually shown by the link down at the bottom. They go through and talk about some of these in greater detail. Anything jump off the page that you can?
Well, what jumps off the page, Mark, is an accommodation that I've seen in a number of different companies as I've been updating the companies that I own, and the accommodation has to do with deferred taxes. I'm still a little bit fuzzy on exactly what deferred taxes mean, but I think I can wrap my arms around it well enough to explain it in broad brush strokes. Deferred taxes are taxes that had been anticipated that needed to be paid by a company, and so they set aside money to pay those taxes, but then when the tax rate went down, they found that they had set aside too much money. So the excess that had been set aside to pay these deferred taxes is now going to appear as an adjustment, but instead of an adjustment in the direction that you would expect, adjusting up, this is going to add cash on a one-time basis to a company, and that means that if you're adjusting to try to get a good idea of what trend is, that you'll be actually adjusting downward rather than upward. I guess what I'm telling people in the clubs that I belong to, and as I travel around mid-Michigan here, I'm telling our clubs to be very careful when they see an earnings line where the last earnings, if it's matching the calendar year, where the earnings that included December 31st, the end of the calendar year, if those suddenly take a shot in the downward direction off of trend or in the upward direction off of what trend has been, that's usually an indicator that there are adjustments that are being made, and you're going to want to do a little bit more digging. Our data, remember, the Morningstar data reports what's happening in GAAP numbers, generally accepted accounting practice numbers. And those are the numbers that the companies report directly to the SEC in their 10K and 10Q reports. We're trying to adjust those numbers, especially this year, because of these repatriation taxes, these deferred taxes, and a number of other different things that are going to change on a one-time basis what's happening to the earnings line. So if you see that earnings that includes December 31st, if the company's on a calendar year, then that's the last fiscal year's earnings. If they're moving up much more steeply than you would expect on the trend, or if they're moving down much more steeply, and we're going to show you some examples of those kind of things tonight, then that's a good indicator that you're going to want to probably do some adjusting of the numbers themselves. So I think without further ado, we should start to show the examples and give people an idea of what we're talking about. The only other point that I'd like to make is that if the company is not following the calendar year for its fiscal year, then you might see those adjustments. You probably will see those adjustments made in the quarter that contained the day December 31st. So if they just close their second quarter on December 31st of 2017, then those adjustments are probably being made in the second quarter numbers of their fiscal year. And again, you'll see that quarterly dot suddenly shoot upward or suddenly shoot downward way off of trend because of the adjustments that are being made.
Yeah, and one thing that I will do for the audience is there's 5 or 6 articles that probably deserve to be a bibliography. I'll actually post those on the forum so people can access them. And for example, they do cover the topic, the opposite end of where Ken was talking about on deferred liabilities, especially for early stage investing companies. I mean, think about it. You've been building this pot of deferred liabilities, hoping to offset future taxes, and now you have less taxes to offset than you thought you were going to have. That's kind of an interesting situation for some of these smaller early stage companies, just as an example of consequences. All right, just as a quick reminder, as you know, as we've been going through the weekly updates at Manifest Investing and keeping track of the value line expectations for 2019 and then out to the 3 to 5 year time frame, that envelope of time that we're just simply calling 2022. And for that matter, this calendar year, 2018, you can see that the analysts are basically seeing a pretty good bolstering of financial performance for companies. We will watch that all the way through the end of the first quarter as we do the updates and ratchet the data array in the database to reflect the value line updates. We're about halfway through, and this is what it looks like at this point. Again, after many years of a relatively flat plateau, is it going to take off? And if so, stocks might not be as overvalued as we thought they were. So only time will tell. All right. Some of the remarks that, again, from a global standpoint, come straight from the Wall Street Journal, and this article that raised the concerns. I think this is back from late December about how the new tax law is about to make analyzing earnings trickier. And since earnings are kind of at the core of our stock studies, anything that disrupts those could be potentially disruptive to our stock studies. So we want to understand a little bit more about it.
Mark, I'm going to cut in. We have a hand in the air from Bruce Buxton. Bruce, I'm going to unmute you. Go ahead with your question, Bruce.
I do not have a hand in the air. I don't know. It just keeps coming on all the time, so looks like an error.
I will put the hand down. Thank you a lot.
Could be those gremlins in the Aurora. More on gremlins later, perhaps. I'm tired of gremlins, folks. So anyhow, we're looking at some fairly large chunks of money on that right-hand side of the amount of billions of dollars that they're talking about having to pay to offset and access this repatriation opportunity. Apple has nearly $300 billion in assets and cash offshore, and we're talking about a tax bill somewhere in between $35 and $40 billion. And then we're going to talk specifically about the fourth one down, Johnson & Johnson, that I believe ended up closer to 14 billion or somewhere in that range. But again, they're paying $14 billion for the right to access approximately $80 billion in assets and put it to work where they want to put it to work. So these are not small numbers, as we're going to demonstrate for a couple of the companies, and fairly major events and very disruptive. Any other thoughts on that, Ken?
No, but I think this is a nice sample of some very large companies that are they're quite popular in our community. I would imagine that almost any investment club is holding 1, 2, maybe even 3 stocks off this list in their club holdings. At least one on the list, probably.
Well, Apple continues to be the most widely followed company by our subscribers, so pretty sure that's pretty much the case for the entire community. There's some comments at the end. I realize these are a little bit small, but I just kind of got a kick out of some of the comments from readers. This is on the back of that Wall Street Journal article, and they're just going, some of them are a bit snarky. The first one starts off pointing out that this is not rocket science and it's not really that big of a deal, as is seconded by the second one. This is just to simply figure out earnings, what are the real earnings, and it's not really a big deal. The third guy says this is really much ado about nothing. Cash flow is what really matters. What's the big deal about inviting another line item to the party? And I love the fourth one down there too. His point, tongue in cheek, is that, well, their tax payments are a lot less than they would have been if it was still at 35. And again, just some snarky comments about wow, the stuff that is being kicked around and the whining that's being done is nothing new. In the stewardship and the study of the companies that we try to track, we care about this stuff. We look at how this stuff all comes together and affects the long-term value of a company. So again, the adjustments will be made. We just have to be aware of what's happening and come to grips with it. And then last but not least, that question just makes the point that it's not really all that complicated, but there is some complexity. There's going to be some juggling of numbers. And again, it really is pretty straightforward to correct for that one-time annual tax bite. And that's the type of thing that, as Ken has already said, we've got to be watching for, understand it, and then factor it in going forward. So let's talk a little bit about one of the companies. Here's Johnson & Johnson. And I believe this one fits the bill for what you're talking about, Ken.
Absolutely, Mark. This is a company that's owned by a couple of the clubs that I belong to, and we started discussion on Johnson & Johnson about a month and a half ago once these earnings came out. And the first question that came from one of our newer members in one of our model clubs was, well, why can't I just start my projection from whatever the earnings number happens to be? And I likened it to starting a marathon race. If you start a marathon race in one place, then you end up about 26 miles down the road, and it's continuous. You can't jump around. It's not quantum physics. So you take a nice continuous line and you get to the end of the race. But if you start the race 12 miles in front of the other guy, then if you're still going to run a marathon, you're going to end the race 12 miles in front. And we pay a lot of attention to where this estimate of earnings takes us 5 years from now. Over on the right-hand side, in the year 2022, I'd like to have a reasonable estimate for earnings after they've grown at whatever the percentage happens to be that I've decided earnings are going to grow at. Well, if I start my projection from this dot that's way, way off of trend, I mean, you just take anybody looking at this graph knows that there's something happening with this dot, this piece of data right here. If I start my projections from that dot and go 5 years out, I'm going to end the race in a nice continuous fashion at a nice, steady, whatever the growth rate happens to be that I set. The only problem will be that in reality, the race should be starting somewhere generally on trend, and I should be not including things that happen only once and then don't happen again. So I'm looking for a dot. I'm looking to adjust these earnings and bring this dot somewhere up, generally on trend to where it's been for the last 2, 3, 4 years, so that when I start the race at that point, I'll end the race somewhere that makes sense as far as the analysis is concerned. I need to start the race in a proper place so that I can end it, so that I get a number that makes some sense. And that's an important number on the stock selection guide that transfers to the second set of calculations. We used to say the back of the stock selection guide. That earnings 5 years in the future is important, and that will change dramatically depending on where I start to calculate the growth in earnings. A long discussion on a very profound, very misunderstood idea that you need to make sure that you have a reasonable earnings number that doesn't include a lot of one-time charges if you're going to make a good projection and get a good earnings number 5 years down the road.
I agree. I mean, I think if you think about what are we really doing when we do a stock study, and again, we come back to that word imagine. We're trying to visualize what that company will look like 5 years out. So it comes down to the representation, is the way I think about it. And this for me. It's I'll keep it much simpler than Ken. It's what you're talking about, Willis moment. Anytime I see a point that far off of what's going on, I got to dig in deeper and figure out what's going on. And that's literally what's going on here. Again, the amount was $14 billion that they took in December in order to access $80 billion of resources and potential for the next 5 years. It's important to keep that in context as we're going. And again, in fact, Ken, why don't you go ahead and reinforce where you get all of your how you win all those polls on the roundtable, leaning on investor relations.
I'll tell you one thing that I like to do. We're getting the feedback, Mark. One thing that I like to do is to go to the company website and start with the press release. Now, this happens to be a slide out of the presentation that accompanied their earnings call for Johnson & Johnson. But the press release gave me the exact same information. I first of all noticed that 47 cents diluted earnings per share, and that's the number that's being reported to the SEC. That's the GAAP number, and that's the one that I see down there all by its lonesome on the graph that we use for the SSG. But when I look further, I look right next to it, and I see an adjusted earnings of $7.30. Now, I don't know what makes up all of that adjustment. I can figure it out. It's going to be spelled out for me in the press release. It's going to be spelled out for me in the report that they file with the SEC. And in fact, this particular presentation that's on their website does spell out most of the adjustments that Johnson & Johnson make to go from the 47 cents GAAP earnings to the $7.30 adjusted earnings. Notice in the bottom down there, in the reference to the slide, you see the words non-GAAP. And you can think of non-GAAP or the word adjusted as being synonymous when you're looking at financial statements, especially in this time of a lot of different adjustments going on. I kind of laughed to myself when the banks started referring to the last quarter of last year as the kitchen sink quarter. Because they were going to do all kinds of adjustments, some of it having to do with regulation, some of it having to do with taxes, but they were doing all kinds of adjustments and putting them all into the fourth quarter to get them out of the way so that as they move forward, the earnings that they reported were relatively clean and could be compared one to the next to the next. With all these adjustments, we've already made the point that comparing without adjusting is not a good thing for us to be doing on a stock selection guide.
So again, as we do our studies, again leaning on second opinions that we trust and know have been fairly reliable over history, well, here's one of our favorites in the community, jumping to Johnson and Johnson, and we actually note that they have come in and made their adjustments here on the fourth quarter and the full year, and you can see that they did not give the full $7.30 as noted by Johnson and Johnson, but for whatever they had their reasons for selecting 620. That number is still more representative of the long-term trend and what's actually happening at this company going forward. And it basically the notes are right there to tell you what's going on and the stuff that they're looking at. You can see the $13.6 billion write-off. So again, as you develop a deeper understanding for any company that has one of those Willis moments, you can get a good opinion to lean on. So using the value line numbers, we get a completely different picture. I think it's, again, in terms of how we are seeking a representative perspective on the company going forward. You see a company that is destined, they've been doing a lot of product portfolio divesting and managing and shuffling. That accounts for some of the flatness of the profitability over the last few years and some of the flatness of the revenue line. And as you come to understand that and think about the company with the product portfolio hopefully positioned to actually have improved profitability and perhaps even jump started with some of that $80 billion coming back. They haven't said they're bringing all 80 billion back, but that's what's available to go after in the case of Johnson and Johnson. So again, keep it in perspective. Watch for that moment that should be a nudge to, and some of them are going to be more subtle. The one that we showed you here is, pretty much a clarion. Can't get much clearer that kick in the side or a nudge there. Some of them are going to be a little bit more subtle than that. Any other thoughts on this, Ken?
No, I'm pretty clear. We're getting a question. Does the company have to pay the repatriation tax and bring the money back? The answer, it's a two-part answer. The company must pay the repatriation tax. They don't necessarily have to move the money back to this country. They have an option of moving all or part of that money back, but they must pay the tax on the full amount of money that they've stored up outside the borders. Now, that's my understanding. If there's a slightly different call on that, I'd like to hear it in the question box. We're also getting a question, Mark, if you could go back to the value line page real quickly.
Mm-hmm.
We're getting a question about the 620 in the full year, which is still in italicized type, even though the 4 quarters are in regular type, which would indicate that those numbers are pretty fixed. I'm reading over in the analysis right to the right of the charts, the first paragraph that starts out Johnson & Johnson's fourth quarter, and I think if you read there, you'll notice that they have decided that they are going to adjust it to 620. So I think that type just didn't get altered to be in regular rather than italicized type. But I think that is the number that the Johnson & Johnson is going to be adjusted to as far as value line is concerned. Remember, that's not the number that we saw in the company's press release, which was 730. So there are other adjustments that Johnson & Johnson made, and Value Line is choosing to ignore those other adjustments. Value Line makes the point in the analysis, if you read that paragraph, that they usually try to stick pretty closely to GAAP accounting, but they are going to violate that rule a little bit because of the amount of the non-recurring charges that are being accumulated right now. So I think that 620 is actually going to be the number that Value Line is going to use, and it should be in regular type. I don't think that that's still up for I don't think Value Line is still deciding what number to choose.
Yeah, and typically that'd be the case. Although in these times, turbulent times, I wouldn't be surprised to see them perhaps even adjust that slightly with the next quarterly, but probably not. All right, should we press on, Ken?
Absolutely.
All right, the other one, and the magnitude of this is staggering. The other one is Apple. Again, a very widely followed company by many investors within our community. In the case of Apple, we're looking at, you can see here, that's probably an old number, a little north of $250 billion overseas. And the notion of bringing that back, keep in mind that that actually exceeds the total annual revenues for 2017. So there's a lot of things that they can do with this money coming back, from buying shares to investing in the company to perhaps issuing a bigger dividend. There's a lot of places where they can try to take them funds and actually pay some more people. We've seen in the headlines, we've seen cases of companies paying bonuses and increasing salary at a number of companies. And some companies have actually even suggested that it might allow them to be more competitive, perhaps even going for a little more volume by dropping prices. So there are different strategies that can be deployed. But in this case, keep in mind you're talking about, again, more than the annual revenues. And you can see that net income from continuing operations is right around 50 billion. So again, you're talking about 7 times that number, or 6 times that number available for changes. I do know that Apple has, I'm not sure when they did it, but has recently announced, much like Amazon, the creation of a second corporate headquarters somewhere else in the United States. And I saw numbers ranging anywhere from 20 to 40,000 additional jobs coming out of this situation. So I think I can see why some of the analysts and some of the pundits are thinking that there really is some fairly attractive characteristics to bringing that money back and deploying it appropriately. Any other thoughts
Mark,
on this, Ken?
let me muddy the waters just a little bit more, okay? Apple is a great example, and in fact, if you've been a follower of Ticker Talk, the Better Investing Ticker Talk programs, 2 months ago, Ann Cunez did a beautiful job on showing you some of the same kinds of things we're showing you this evening. And one of the examples that she used was Apple. I just made the point that if you see the trend line on earnings moving down way off a trend or up way off a trend, that's a really good indicator that adjustments are probably being made. And here we are saying that Apple has to pay all these repatriation taxes to bring back huge amounts of money from overseas. And yet, when you look at the GAAP data for Apple, you don't really see any adjustments being made. And the obvious question is, why not? Well, the answer is that Apple has been setting aside money. Think of it sort of like an escrow account where you set aside money for taxes. Apple's been setting aside money for this cash that they've been holding overseas. They knew that eventually there was going to be something to allow repatriation, and they figured that they were going to have to pay some kind of tax on that money as it came back into the country. So they've been setting aside money all along to make it happen, and now all Apple has to do is transfer that money, which is sitting on their books. They just have to transfer it to a different part of their reporting structure and show now that they're using that money to pay these repatriation taxes, and that's amounting to almost no adjustments in their earnings number. Rather than using the earnings to pay the repatriation tax, Apple had money set aside outside of its earnings to pay that tax. So Apple's earnings really have been very clean for a reasonable amount of time. And I think that's an excellent example of corporate responsibility and kind of doing the right thing up front so that you don't have to muddy the waters with a lot of financial engineering. Now, most companies did not do that. Apple was the exception rather than the rule. But I think if you look at the data coming to us from Apple, you won't see that hook down like we did in Johnson & Johnson, and you won't see any sudden hook up like you are seeing in some of the other companies that are reporting with a lot of adjustments in their earnings number.
Well, every time I've got $250 billion laying around, I'm able to do some really creative things with it. So I could never get tired of that, Ken.
Mark, we do have a hand up from Ann Manning, so I'm going to unmute Ann and let her ask her question. Hold on. Ann, go ahead.
Hi, I just was wondering, how long do these companies have to be able to bring this money back? Is it a time frame?
I'm not familiar with what the limitation is. I did read material about the escrow type treatment of basically prepare or set aside the amount, as Ken was talking about a few minutes ago. I suspect there probably is some type of a time frame on it. I do not know. Ken, any thoughts?
Well, yeah, and don't quote me on this number, but I'm remembering 8 years. There's an 8-year time frame on this whole repatriation thing, but most companies appear to be trying to get it out of the way as quickly as they most possibly can. And I think you'd want to ask that question if they're going to defer. I don't think they have the right to defer the payment of the taxes. I think they have the right to defer the bringing back of that cash, however. But again, I'd want you to clarify that with an expert in the accounting. And I'm not an accountant, and I'm just trying to remember what we spoke about when we were talking about that. Okay?
Yeah, and there is some type of a time schedule on the taxes that's available too. It's over a number of years, and I remember seeing 8 also. I don't remember the specifics. Anything else? Good to hear from you, man.
No, we're up to date, Mark.
Okay, let's go ahead then and talk about Berkshire Hathaway a little bit. Their annual meeting is coming up in a month away now, and they've already released their annual report and their annual letter to shareholders. Many of the people in the audience have probably read that. It's fairly straightforward this year. He did talk about his 10-year bet against the hedge funds that he recently won and donated a whopping amount of money to a charity. But again, this Berkshire's recent results, again, fourth quarter and 2017, actually have quite a bit of disruption in it. In his own way, Mr. Buffett talks about what's going on. He says basically half of the December results are U.S. tax code based. And he does go on to talk about something that we all need to be aware of, and I think this is probably going to be the case for many asset-based companies, is because of the fact that they are now recognizing and reporting financial results on unrealized investment gains. Future quarterly reports and annual reports are very likely to have very turbulent results. And he goes so far as to say, wow, the stuff that we're going to be reporting on that will actually not be a reflection of what our business is really doing and the future value of our business. So this is a fairly serious thing. And he closes with, what many people have expressed concern about, that the earnings per share line, the bottom line, will be quote unquote useless. And that's I got to say that's pretty disquieting to me, and the potential to confuse especially beginning investors is actually quite large. Any comments on that, Ken?
I just nothing except to agree, Mark, that I think that there wasn't a lot of thought put into how some of this could be explained to the average retail investor. And it's just another nail in the coffin, as far as I'm concerned, of making investing accessible to the average American. I think that this gives a lot of ammunition to the I'm going to call them experts because that's what they call themselves, but I'm not sure that they can produce any better than a lot of our high functioning clubs can do. But it just gives them more ammunition to convince people that they should be paying other people significant sums of money to manage the money that they've accumulated over the years towards their retirement. Fees of 7, 8, 9%. because those people know better. And I just am disheartened by that kind of thinking.
Yeah, I hate to see anything that introduces confusion where it doesn't need to be, and complexity where it doesn't need to be, and some of this is actually doing some of that. It's kind of tragic. In addition to just that, again, some of the repatriation type comments and that sort of thing, the change in the income tax rate from 35 to 21% accounted for a fairly disruptive moment in the 2017 results also. And Mr. Buffett, in an interview just after the results were released, talked about the new tax law. Yeah, it's disruptive. It's got some ugly moments, but it truly is a potential tailwind for business. And they have been quite clear that Berkshire is much more likely to buy back shares rather than to pay dividends for the first time in their history. So there's a link there to some of this information also.
Mark, we're getting some good questions from Bob Hool, and I'm going to answer them out loud, or at least begin the discussion on the questions out loud here. Bob starts by saying, okay, using the preferred procedure, if a company is consistently paying 35% taxes under the past years in the history, can we drop that down to 21% going forward and use it to help us do the analysis? Bob, I don't think it's a one-for-one trade-off. And the problem happens to be is how will they use that money that they're no longer paying in taxes? If they're going to use it, for example, to increase the wages of their workers, that's going to change their expenses, because paying wages is an expense. So the taxes will go down, but their expenses might go up, which means their margins, their net margins, their pre-tax profit margins might go down depending on how they're going to use that money. Bob also asks, well, how about if they're buying back shares of stock? In my estimation, Bob, companies are notoriously bad at deciding when they're going to buy back shares of stock, and many of them buy back their stock without any regard to whether it's an actual good buy or a bad buy. They pay too much for their own stock many times, and we know, being in clubs and investing on a regular basis, we know that one of the biggest mistakes that better investing members can make is to buy great stock, but to buy it at too high a price. And I think companies do that because they're tied into arbitrary time schedules, which don't take into account whether the stock is actually at a good place to be buying back, whether it's in the buy zone or not. So you put all those things together, and that's why I think that everybody is cautioning everybody else in the better investing community right now that you have to be extremely careful when you use the preferred procedure. It's not just a one-for-one trade-off, and we won't start to see numbers that we can truly begin to rely on probably until at least 4, maybe even 5 or 6 quarters have gone by with the new tax law in place. Once we start to see some numbers as to what the effective tax rate will be, what the new margins are going to end up being, then I think we can start to get a handle on the preferred procedure once again. But our historical numbers, especially for tax rates right now, are going to be something that are not going to be nearly as helpful as they were 6 months ago or a year or so ago. I guess what I'm doing is I'm cautioning you to give a lot of support and to be very slow to sell and to be very slow to buy. Make sure you understand exactly the situation in your company before you drop it from your portfolio or before you add it to your portfolio. It's going to be a little bit more complicated. It's going to take a little bit more time. And I know that my clubs are not used to spending the kind of time that they're going to be forced to spend this year in doing some of the adjusting and some of the analysis to decide whether they have a really good company to invest in or not. Mark, where are you coming from on questions like this?
Yeah, I would just point out that that's the statutory rates. So For example, a company that has a current day 35%, you could actually see a tax rate of anywhere from 15 to 40%, depending on their actual specific situation and their geographic distribution, any subsidies, that sort of thing. What you want to watch for, because the companies are beginning to release these numbers now, is their expected effective tax rate. And they will actually spell out the numbers for effective tax rate in some of their forward-looking statements. So you want to watch for that. And that is a number that you could perhaps consider using in the preferred procedure. And then I'll just double down on Ken's comment about we watch the companies buy back their own stock. Sometimes they don't do it very prudently. That can be an indication of management that's not really looking at the world the right way. I mean, I don't know any other way to put it. I mean, I think back to a meeting I had with representatives of 8 companies in our conference room years ago, and we went through and talked about the way we look at companies and what a buy zone actually is, and we actually showed how a couple of the companies in the room had repurchased and bought back shares when the share price based on the return forecast was extremely unattractive. And a couple of the representatives took me aside afterwards and said, "I want to take you back to our boardroom." And I said, "Well, I don't think I want to start a fur fight, but again, this is something that we see happen. I think we will watch for this with all this deluge of cash that's going to be thrown at this situation. Again, if the company is buying back shares when it's in the sell zone, they're not managing very well. So I want to be careful about that." On the next slide, again, taking a look at Berkshire Hathaway, you can see that there's already disruptive stuff going on the right-hand side of the earnings picture for 2017, 2018. We're going to have to figure that out as a community of investors when it comes to Berkshire. There are a number of analysts that are starting to talk about how maybe for a company like this, it's time to think a little bit more about price to book value in some of these situations, and that's got some vulnerabilities too. So I'm not sure I'm sold on that. What I think I am sold on is keep doing the things that we're doing, but understand some of that commotion that's going on the right-hand side, and build your return on equity forecasts and your book values appropriately using the same time-honored methods. By the way, I do point out to everybody that slide is the first page of his annual letter to shareholders. Take a look at that and think about it. So again, we're talking about $1 trillion here, guys, from just 16 companies. So it's something we want to be aware of and watch some of the stuff that Ken and I have been talking about. I was amazed when I totaled that up, and yeah, it's $1 trillion, and that's obviously some fairly decent tax revenues that are coming in. But more importantly, the power of the resources and the enabling nature of some of these funds and what they can do for some of these companies and here in the United States. Any comments on any of those, Ken?
We talk about trillion and it doesn't seem to have much of a meaning anymore. I mean, million is just so common, and we throw billions around, and now we're talking in trillions, and yet it's more money than any one of us, I think, can even fathom when we even talk about 1 billion, let alone $1 trillion.
Yep, it's $1 trillion here, $1 trillion there. We're talking about real money. All right, so let's just go ahead and close with just some comments, and then we will open it up for questions. We just want to reinforce with a couple of things. The notion that this is going to be a work in progress for some time, and the reality is that some of this stuff is going to be a one-time momentous disruption. Consider going to places like Value Line, some other trusted resources like Morningstar, et cetera, and understand what you're looking at during your stock studies, but get some support, especially for the stuff that looks more questionable, like what you're talking about Willis moment there a few moments ago. Optional. We do this for some early stage investing and for some more cyclical companies now. We actually use cash flow instead of earnings already, and this is not a new thought. In fact, Arnold Bernard, the founder of the Value Line Investment Survey, again, the point we've made many times over, the Value Line company reports that you see, much like the one that you're looking at here on your screen. It's a stock selection guide. It's a stock selection guide that happens to actually be based on cash flow instead of earnings. The beauty of that is it avoids all this chaos. So, maybe a tip of the hat to Mr. Bernard and Value Line, because they're operating below all the accounting disruption line, or above all the accounting disruption stuff. So maybe take a look and just play with as a homework assignment. Think about the price to cash flow. For any company, Value Line actually does disclose the cash flow that they're using for the company in the Legends box. I don't know what company this is, but for them, they're actually using, just like you would a PE in section 3 of your stock selection guide, they're using a price to cash flow ratio of 12 to build what they call the value line. The value line is the line where they think this is a representation of the reasonable price over time. In the picture that we're showing here, this particular stock would have been overvalued in the opinion of Value Line because the current price is above the value line. So you're looking for buying opportunities when the monthly price is shown on here, dips below that value line. Again, think stock selection guide, only using cash flow instead of earnings, and you get there. So you can avoid the accounting-driven confusion and disruptions that we see going on. And last but not least, be watchful and mindful of that extra turbulence that Mr. Buffett was talking about when looking at asset-based companies. And it's probably not limited to just them, but certainly those that have a larger investment or asset management portfolio are going to be more vulnerable to the volatility of the stock market, as if we didn't need any help there here in the last month or so, now that we've been reminded what volatility is. But there is going to be some extra turbulence. So be aware of it and just be mindful of it. And in his words about, there will be times when it doesn't really reflect the future of some of these asset-based companies. So be mindful. Any other comments that you'd like to make there?
I think another broad stroke kind of solution for folks that are grappling with these issues is to remind themselves that these adjustments are pretty clearly spelled out in the press release that came from that contains the December 31st date for a calendar year company. That's the end of the fiscal year as well. Many of the companies have gone so far as to pull their GAAP and non-GAAP numbers out and put them in a chart right at the top of the press release. So even if you don't agree with every single adjustment that the company makes, it's a wonderful starting point to use the adjusted number as you're beginning to study what your company is doing. As you dive a little bit deeper and notice that the adjustment is made up of 6 or 7 or 8 different entries, then you can begin to make value judgments as to which of those adjustments you think are truly one-off items, one-time only items. The payment of the repatriation tax is a one-time payment. That's pretty definite in my mind, but there are other items on many of these adjustment lists that you might have a little bit of back and forth in your mind with. If you find, for example, that your company is adjusting for the payment of stock options on a yearly basis, well, if they're doing it on a yearly basis, that's not a one-time adjustment, and I'm not so sure it should be adjusted at that particular point. So if you even start with the adjusted number that's coming from that press release, that'll give you a better idea of the number, the starting point for that marathon race, which is 5 years in the future. And it's so important to get that starting number correct so that you get the finish line placed correctly. That's where all or most of the heavy-duty arithmetic on the back, it's based on that single number, and it all flows from that number. So it's so important that you have a good idea of what the earnings are going to be 5 years in the future. And I agree with Mark that especially for early stage investing where the company doesn't have earnings, but it has cash flow going on, considering price to cash flow sometimes will help you do a much better analysis than looking at a company that doesn't have any earnings and therefore has no real PE values of any kind.
All right, so that is our last slide. We can probably open up and take some questions. We're at an hour, so.
Okay, I'm going to unmute Ann Manning again because her hand is in the air. Ann, go ahead.
Okay, the last slide that you showed, let me see if I understand this correctly. You're saying that to get the future price that we're to take that legend times cash flow per share? Is that what you're saying?
So to get the future price, right, what you're going to do is take the cash flow forecast that you would build, just like you would build an earnings per share forecast,
Mm-hmm.
and use that price to cash flow number, whatever comes out of the stock selection guide for a price to cash flow ratio. You're going to, again, keep in mind everybody here is less familiar with price to cash flow ratios. Everybody's got a general idea what a PE ratio looks like. A cash flow ratio is going to be a little bit, price to cash flow ratio is always going to be a little bit lower. But
so other than getting it on Value Line, where am I supposed to get this number?
You can get it from a source like Morningstar. You can also get cash flow from, I believe it actually even shows up on some Yahoo. Let me take a quick look at Morningstar. Let's see if.
Yeah, Ann, I want to remind everybody there about their 8th grade general science course. When you take a unit that has a per in it, like miles per hour, and you multiply it by whatever the unit is in the denominator, you multiply it by hours, you end up with a number that carries the units of the numerator. So miles per hour times hours, the answer would be in miles. Price to earnings, that's a fraction with price on top, earnings on the bottom, times an earnings number always gives you a price value. That's the crux of section 4 in our SSG. We multiply a PE times an earnings and we get a price. And on Value Line, it's price to cash flow. Cash flow is the denominator, and then you multiply it by cash flow per share, and you end up with another price. So we're just doing simple multiplications, and they happen to work. Where do you get the numbers from? Well, these numbers are just standard numbers that are available in almost any of the sources that we use on a regular basis. Mark, I know they're available in the, and I keep calling them S&P, but they're different letters now. They have a different call letter to them, but it's the S&P data. They're available in Morningstar data. They're available in Value Line data. So you can find these numbers if you choose to use this particular metric. It's not any more or less available than a PE number is more or less available.
Mm-hmm.
Okay, so the what you have up now, we're going to take 13 times 21.30.
That's correct.
To get a future price.
Yeah, that would give you a future price of, say, 270, 280, which is going to be right in the middle of this range over here. That's how they get those numbers.
So that's just going to be an average price.
That's an average price over there. Keep in mind they have a plus or minus range, how in whatever they do. So that's how they come up with that range. And then as another source of those numbers, and these are going to be, it's a slightly different flavor of cash flow, but it will work. You can go to Morningstar and actually look at, this is not per share, so you'd have to switch it to cash flow per share. But you can see here's 5 years, and you can switch it to 10 years. And So
we're going to put that on the back page of the SSG instead of the PE times the earnings. We're going to do times cash flow.
Yep. And we'll actually, I'll include a link that shows how we've done this for a couple of companies. And again, it's not something that's required, but if as a more advanced investor, you certainly fit that bill, you can see where, what is Value Line looking at, what did Arnold Bernard see when he started Value Line 80 years ago. Then that's why they make that decision. Good
Okay,
stuff.
Jacob Berry has his hand up. Jacob, you're unmuted. Go ahead.
All right. Thank you. First of all, I tried to post this on a question. I couldn't get anything to go in the box. So I'll just say, go back to slide 8 with Johnson & Johnson.
Okay.
I think it'd be kind of helpful if you would just say delete the 2007 data and then extended the projection line from the trend line. Recently, I've tried this on a number of stocks such as CVS and MCK, for example.
Mm-hmm.
It as a starting point, I'm kind of relying on the in addition to that, if you delete the say 2017 data, see the trend line will pop up.
Yeah,
pretty close to right.
Jacob, Mark can't do it on the slide because the slide's not live.
Well, if you do it, it does come up. But actually, now at the kind of a first cut through, I've been kind of relying more on Value Line because it takes care of the non-GAAP numbers, and
absolutely.
So that's a good place to start. And then since I'm a Manifest Investing subscriber, I can also go there and rely to it, and then kind of back up into the SSG and so forth. I guess a little bit convoluted.
Yep. Thanks a lot, Jacob. Nick Strategos. Nick, your hand is up and you're unmuted. Go ahead.
Yeah, I just wanted to point out too that one of the other disruptions, as Buffett talks about, is going to be in the traditional PE ranges, I think, for companies. When we do our SSGs, we rely on kind of a normal PE. I think that as we go forward, because the E is going to get disrupted, where is that the normal PE range going to be? Is it going to shift up? Is it going to shift down? And I think that's just one more argument to do the cash flow per share as a double check. Because until, like you said, Ken, it's going to take maybe 6 quarters or 7 quarters. I think it's going to take 3 or 4 years for us to understand what the new traditional PE ranges are going to be for the companies that we study.
That's a good point. Yeah, I completely agree. I think that it probably is going to take some time to shake out. I also think that some of the elevated PEs have been anticipating this a little bit, so they're going to get ratcheted back with the larger E's as they take shape. We'll see. It's really hard to call that one.
Carol is reminding me that S&P is now called CFRA. So if you're looking for S&P data from your broker, most of the brokers, not most, but many of the brokers have what used to be called S&P data. It's now under the call letters CFRA. It was kind of, that data was bought by this new company from S&P. I'm looking at questions here. Susan from Wisconsin, Susan Michelik says that Kim Butcher subtracted dividends and capital expenditures before she dealt with the price to cash flow. And Susan, you're absolutely right. She was doing a discounted price to cash flow. And there's nothing wrong with that thinking as well. I think you just want to kind of be consistent. Mark was showing what Value Line does, and Value Line does just a straight price to cash flow.
Yeah, and they have their own flavor of cash flow. I think they add back in 2 non-cash accounting entries, and it's not quite operating cash flow, but it's fairly close. And you're right, Kim likes to account for, especially in a company as it builds out the CapEx spending, and make that part of her price to cash flow ratios as she maps it out. Again, you're just talking about a different way of looking at it that is, as long as you're consistent, it's perfectly okay.
Claire is saying that she has the Johnson & Johnson annual report in front of her, and she's not finding any analysis of the non-GAAP tax repatriation, yet it's on their website and it's in their press release. And Claire, I would suggest that the annual report is a PDF document and it can be searched, and you might search for adjusted, the word adjusted or adjusted tax rate or something like that, because I know that in almost every annual report that I've read, and unfortunately I haven't read the Johnson & Johnson yet, although I do own the stock myself, I'm sure that there's a table that shows the adjustments and kind of lays them side by side with the GAAP numbers. So I know that table exists, I just don't know where it is in the annual report. So I would do some searching, and if you need to know the different keystrokes, do a Google search on keystrokes to search a PDF document, and you'll get the answer without too much trouble. Gene is saying, when a company buys back its own stock, it will improve earnings, but not net income, because it's only charged against stockholder equity on the balance sheet. So she's suggesting that you also watch net income as well as earnings. Thanks for the suggestion, Lisa. I'm sorry, that was Gene. Thanks for the suggestion, Gene. We appreciate that. I'm looking at Jane Johnson right here, and Jane says, am I right in thinking that we can't just ignore this one-time charge because the company can now do something with that extra money? The money will not just go away next year, right? Mark, you want to take that one?
Well, yeah, I mean, in the case of J&J, you're talking about they're basically taking $13.6 billion out of their bank account and and recording that, and then they have these $80 billion that they can now do something with. I don't know if you want to hand me a dime or if I can hand you a dime and get back 80 cents, I think that's a pretty good deal. So yeah, they are going to be able to deploy it in hopefully very strategic ways. Good to hear from you. I'm impressed with a lot of our friends are here tonight. Thank you so much.
I think that I've covered most of the things that we're asking questions. We have a fair number of comments on various things, but I think that for the most part we've answered a question. Here's a question, Mark, for you from Dan Spira, or Spira maybe. He says, how accurate do you think analyst earnings forecasts are these days, given the early stage of the tax consequences? Are the companies themselves giving guidance for all of these earnings estimates?
Wow. Probably less accurate than usual because of the number of variables involved. So the answer is probably less accurate. With what's going on. It's a work in progress for them too. I do think that they are working very hard to try to figure out, as Ken was talking about, the multiple dimensions of what can be done with these offsets, if you want to think of them that way. That's some serious work. In fact, as Nick was just saying, Buffett talked about PEs. He also talked about how there's a bunch of analysts out there that might have to do their jobs a little bit more, and in looking at that kind of stuff. So yeah, it's a challenge for all of us, and they're not immune, would be the way I would look at it.
I do want everybody to know that we've spent some time in the last two Ticker Talks on this issue of taxes, and that I'll be joining Ann Kuniaz at the National Convention in our Ticker Talk Live, where we'll be doing a talk on taxes and showing some examples and making some recommendations. We feel that every month that goes by, we're learning a little bit more on how we can handle some of these issues, and we're getting more and more examples that can show you exactly the kind of things that we're talking about. There's also some wonderful resources on the Better Investing website. If you're not sure how to adjust the data once you get into the SSG Plus, or once you get into the Core SSG, or into Toolkit for that matter, there are different sources right on the Better Investing website. They're free, that walk you through the different things you can do. On your SSG Plus or your Core, there's little tabs off to the side, and one of them is a question mark tab. If you click the question mark tab, you can see some links that will lead you to some different types of education that can help you learn how to actually do the adjustment in the tool so that you can use the tool then to do your analysis. So stay tuned, listen to the things that our community is presenting, and we'll try to keep a cool head and keep you appraised of what's going on as we go from 1 month to the next. It's going to be a great ride for the next year or so, I'm sure. Mark, one last question from Debbie, and it's one of our traditional last questions. Where will this recording be available for review?
Okay, probably the best way to find it will be go to youtube.com and just search for Manifest Investing. You can add Turnout Tuesday if you want, but you'll find it with just that as it's there. We archive all of these sessions, our special interest sessions, along with the roundtables. And you can subscribe to the channel if you like it, and every time we put one up, you will be notified. I can demonstrate that if you would like real quickly, Ken.
Sure, why don't you, Mark? I'm calling for last call for questions. Right now we're clear. No hands in the air. Mark is showing you on the YouTube channel what he did. He typed in Manifest Investing.
You can even do the round table if you want.
Yeah,
but
and here they are.
And so just go ahead and go to the channel. Here's the Turnout Tuesday from last month where we did a mailbag session. Here are the round tables, including the one where Kim took away all the awards. She was a trophy hog. But all of the sessions are there. And again, if you'd like it, you can go ahead and hit the subscribe button, and we'll let you know anytime we post. Might take a day or two to get it up, but we'll do our best.
So I'd like to thank you all for coming. We had a wonderful audience this evening. In fact, we had a record-breaking audience this evening. So thank you all for coming. And hopefully we'll see you at the April Roundtable. That's the last Tuesday in April. And you will, of course, get a reminder from Natalie to register for that particular program. As always, Mark, thanks so much for all the work you do for these programs, and it's always appreciated. And good night to our audience. Talk to you later. Bye-bye, everybody.
Good hunting out there, everybody.